Hello and welcome to our market alert video for today, which is Friday, February 17, 2023. And this has been a very interesting week, and I can't wait to tell you why I think so. We got a lot of data this week on the inflation front, which of course is the number one topic when it comes to, investors and the stock market. Everybody's focused entirely on that, it seems like. And the data was not good. Inflation's higher than maybe people thought. It seems to be more persistent than people thought. And so you would think that the stock market, the Dow, the S&P would have fallen off a cliff with that news. But actually, it has shown remarkable resilience. In fact, on the day that they announced the inflation number last Tuesday, it was very interesting to me to see how the market went down at first a lot, but then recovered almost to being flat at the end of the day. So why this resiliency? Why are investors not scared of these terrible inflation numbers? Well, let's go over what we think is the future, and then how that applies when we compare it to the past, and why perhaps people are not as scared of this inflation monster anymore as they used to be. So let's start with where we go from here. So the inflation, and if you watched my market alert video maybe 3 weeks ago, and by the way, if you didn't, I highly encourage you to go back, download it, watch it, because if I do say so myself, one of the best videos ever made on the topic of how inflation is calculated. Now, of course, I have pride of authorship, so I'm biased, but be that as it may, mathematically, as I described in that video, and I demonstrated, I think, inflation over the next 3 months most likely will go down. And probably what will happen is inflation will settle somewhere around 4%, which is high. The Fed wants to get it down to 2%. We don't think they're going to get there this year, maybe next year, but somewhere around 4% will be where they'll find that real hard struggle point. The other thing is that most likely the Fed now, given this news, will raise interest rates in March and maybe the time after that again. So interest rates may end up going up above 5%, maybe 6%, somewhere in that range. So those are two, so if you have inflation at 4%, we have interest rates at 6%, that's terrible. We're not used to that kind of thing. We've gone like a decade with nothing like that. Well, if you go back in history, what you'll see is that we've had periods of inflation around 4% and interest rates around 6%. And the economy was okay. No mass destruction ensued. No terrible drops in the stock market ensued. So we've been in that place before, and we've managed our way through it. Now, the thing that makes this time different and maybe better than those previous times is that the unemployment rate is very, very low. So what that means is that if the Fed raising interest rates does cause some damage in the unemployment area, in other words, it causes more unemployment, you could see the unemployment rate go up, but still not be in the range that is super high relative to history, because right now it's at the lowest it's been almost since the 60s. So there's a lot of room for the Fed to maneuver on the unemployment front. We've been there already where interest rates appear to be going and where the inflation rate seems to be going, and we've done okay in the past. Therefore, it didn't scare the market overabundantly, and we saw the market go down. Some people reacted to that, but recover by the end of the day. So what does that tell us about the future? We still think that this year has the potential to be a very, very good year if what I just described actually happens. Historically, years after you've got a down period followed by a big up January period, 22 and 23 is an example of that. That year, 23 in our case, tends to historically be a good year. Now, history does not guarantee the future, but that's what it appears might happen. So what do you do about it? Well, as you know, we have our invest and protect strategy. We said to sell in April of last year. We said to stay out for all of last year after that. Why? Because we believed at the time that the downside risk was greater than the upside potential, and therefore we counseled our clients to stay out of harm's way. Now, where are we now? I encourage you to go and go to our website, rpoa.com, and click on Meet with an Advisor. Visit with one of our retirement planners. What we want to do with you is determine, we have we do what's called a retirement cash flow plan. We want to look at the sources of income you have, your expenses, Social Security, all those things, incorporate them into a retirement cash flow plan, an RCFP as we call it. And once we have the RCFP built, we can answer a lot of questions. How much risk should you take? Should you be in the market right now? Can you retire or not? Where do you get your income from? When and how do you take Social Security? It helps us to answer just a whole bunch of questions, and we can do that with you. We'll enjoy the trip together. And at the end, we'll hand it over to you. If you like what you see and you want to work with us, great. And if not, that's fine too. No charge, no obligation, and we will part friends. Okay, so take advantage of that. Our website is rpoa.com. Click on Meet with an Advisor. Love to help you if we could. Thank you for watching this video. Please share it with as many people as you would like, friends, family, business associates. We want to help as many people achieve what we call your retirement, the second childhood without parental supervision. We want your money to last as long as you do, and we want you to have financial peace of mind. So again, thanks for watching this video, and we'll talk soon.